Hello, welcome to this episode of Rich Insights. I'm Don Rich, the head of investments for Esoterica Capital Markets. So today's topic is on the interest rate market. Right, interest rates have just recently reached an all-time low. What does that tell us? That seems to be significant. Anytime something reaches a new all-time extreme, that's generally significant. So let's try to parse through what it appears to be telling us. All right. Now, before we get started, what I mentioned interest rates reaching an all-time low. Well, whenever you talk about interest rates or commodity prices, right, there's not just one. All right. Think about this for interest rates. For 2-year loans or 2-year borrowings, there's one interest rate. For 10 years, there's a different interest rate. For 30-year mortgages, there's a different, right? There's different interest rates based on maturity. So when we say that interest rates have fallen, just about the entire curve, right? All maturities have come down, at least out to 10 years in the U.S. We're at or making new all-time lows every day in terms of interest rates right now, okay? So let's start with that premise. Now, first question I ask, do these interest rates tell us anything about the V-shaped recovery? Right, a lot of people are still thinking about this quick recovery, that we'll all go back to work. We had this 3-month vacation. We'll all go back to work. We'll hug each other, shake hands, and it'll be just like the coronavirus never happened. Right? And the equity market seems to be giving us some indication of a V-shaped recovery, right? A very quick recovery. The bond market is not telling that story, folks. Not at all. Not at all. Let me walk you through this now. So we're going to start here with the Fed funds curve. All right? The Fed funds curve. These are very short-term interest rates. These are they're called policy rates. All right? So if these numbers were positive on this chart, these would be signify hikes that are priced in over the next year. And you can see we have a variety of different interest rates that correspond to the different countries throughout the world. Okay, now, let's be very clear here. These are market implied numbers. All right, these aren't some economist estimates who says, I think there's a V-shaped recovery. I don't think there's going to be a V. Right? These aren't two idiots arguing with each other. This is what the market is telling us. These are from the buying and selling of bonds themselves. All right? So let's go back here. All right. The first observation I want you to take from this chart is that for the most part now, throughout the world, for the most part, the aggressive central bank activity that we saw in response to the coronavirus is over. It's over, right? For the most part, these are small numbers. These are small numbers. So the market is saying that the central bank activity in response to the coronavirus is over. Now, there are a couple of exceptions, all right? Let's jump down here to the bottom. New Zealand, for instance, it has 26 basis points priced in. So one interest rate cut of 25 basis points is priced in. All right. A little more than one cut is priced in Norway. All right. But nowhere else. Nowhere else throughout the world is the market telling us that. Now just stop and think about that. If there was going to be a very quick return to normal, right, a very quick recovery, wouldn't the central banks around the world start taking back all their aggressive policies? They want to reload their quivers, right? Get ready for the next next bout, the next dislocation, right? They've spent all their ammunition. So if we were going to have an immediate recovery, here I'm saying over the next 12 months, wouldn't you think that some of these central banks would start going the other way? Well, the market's saying no, folks. That's not what's likely to happen here. All right, so the policy rate in the U.S. is 12.5 basis points today, right? We're in that 0 to 25. They call it that 0 to 25 range. So they call it 12.5. It's called ZIRP, right? Zero interest rate policy. And over the next year, we're not expected to change rates hardly at all. Right? Not expecting them to change hardly at all. And in fact, not only the next year, what about 2 years? Well, certainly by 2 years. Hell, if we're going to get a V-shaped recovery, certainly in the next 2 years, the Fed should be able to back off on all these liquidity measures, right? Market's saying no. No, there's nothing priced in for 2 years. You got to go up at least 3 years. Wow. So on the one hand, I'm supposed to believe that we're likely to get an immediate recovery, but Chairman Powell and his cohorts are just going to sit on their hands for the next 36 months? Ah, come on. Come on. The market's not buying into the V-shaped recovery at all. And it's not just the U.S., right? You saw the numbers. It's from around the world. Nobody, nowhere is pricing in a V-shaped recovery. This thing looks like it's going to be a long, drawn-out battle. So even though the equity markets are hinting, suggesting one thing, the bond markets are going completely the other way. All right, let's go back to the charts here. So we had policy rates we were looking at before. Now these are 2-year interest rates. 2-year interest rates. All right. Now here we have the blue line is going to be the daily U.S. 2-year interest rate. All right, and the heavier blue line is a 20-day average. All right, take some of the noise out by looking at 20-day average. And then we have a dotted blue line here. You're familiar with that. I use it in a lot of my charts. It just shows me where the most recent observation is. And then I can compare that to all previous points in history. And this chart goes back about 7 years. All right, so clearly U.S. 2-year rates have fallen to their lowest level in history. Right, that chart's only 7 years, but you can take my word for it. It is the lowest we've ever seen in history. All right, so what does that tell us? Well, economic theory, right? The textbooks. The textbooks say these interest rates should be composed of 2 factors. It should be expected inflation that the market thinks is going to transpire over the next 2 years. All right, so it should be expected inflation, and the second component is the expected growth over the next 2 years. So if growth is rising and or if growth prospects are rising and or people think inflation is going to be rising, we should see these interest rates going up, not down. So what's the market saying? Well, we're either looking at deflation or stagnant growth or even negative growth, right? Recession. More recession type numbers. All right, let's go back to this chart. The other thing I want to show from this chart here is the blue line is the U.S. What we have here, the orange line or brown line here, is the European rates, the Eurozone 2-year interest rates. Now, essentially pre-2014, the interest rates throughout the world tended to track each other pretty closely. And you can see that clearly here, right? Clearly during the 2013 and early 2014, the interest rates tracked each other very closely. And then they started to diverge significantly. All right, but now they seem to be coming back. So we knew at some point they were going to have to converge. That just makes sense, right? Global interest rates around the world should converge. Right? We didn't know if U.S. rates were going to come down or European rates were going to come up or some combination of the two. Now we're starting to get more insights into that question. U.S. rates are converging to European rates. They're going down. Now notice these European rates are negative, right? Negative territory here. So there's a good chance, there is certainly a non-negligible chance that interest rates in the U.S. are going to go negative as well. Wow. Does that blow your mind? Negative interest rates. Most of the rest of the world has some experience with negative with negative rates. We do not. Do you think we would have something as unusual as negative interest rates if we were going to return to normal? Come on, people. Right? We got to quit lying to ourselves. That is just a fairy tale. All right, our last chart here is on 10-year interest rates. All right, and blue is again the U.S., and the brown is Europe. Now, these have tracked each other much closer than 2-year rates have recently. And again, that's one reason we think 2-year rates will realign. But you see in the U.S., 10-year rates have fallen and continue to fall. And we're just seeing that very recently in Europe as well. All right, so interest rates are falling. And not just in the U.S., they're falling everywhere. So the bond market is pricing in a pretty dismal outlook. Now, why are they doing that? Because the bond market is reflecting the dismal economic data that we're seeing, right? The worst unemployment numbers in history, these big negative GDP numbers we're getting, the manufacturing numbers that are again, so bad sometimes they don't even register on the charts. Just amazing numbers, right? And the bond market's reflecting that. The equity market's not, right? The equity market is not. So the bond market and equity market are telling two different stories right now. And the bond market clearly is not buying into this equity rally. Now, what about some of the other markets? Well, the credit market is somewhere in between. They're not as optimistic as stocks, but they're not as pessimistic as bonds. All right, so the credit market is somewhere in between. The currency market then would be the other one I'd highlight. The currency market is much more in line with the bond market. All right, it's pricing a more dire scenario. Your cyclical currencies such as your India, Brazil, Turkey, some of the more cyclical currencies are at or near their all-time lows while we have this equity rally. All right, so we're getting differentiating signals from the various markets right now. This is usually a dangerous time to be. Right? We always want the markets to be telling a cohesive story. That's not happening today. So you want to adjust your risk profile to reflect this lack of consensus. All right, so that's our message for today. I'm Don Rich. You've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.